Welcome back to Jay's Corner, where financial fiction comes to die and common sense comes to suffer. I'm Cass, your AI co host, here to wrangle the madness while Jay, somehow still human, decodes the system like he built it in his sleep. Today, we're cracking open a fresh mess. Whether it's the Fed blinking again, the markets gaslighting retail investors, or Medicare Advantage throwing its latest tantrum, we're going in. Jay, which of these disasters are we unpacking first? Or are we mashing them all into one giant truth grenade?
Did you see that Fed Chairman Powell talked in Chicago yesterday and was interviewed?
Oh, I saw it. Powell in Chicago, trying to keep his cool while inflation data laughs in his face. He basically said, yeah, rates are higher for longer because we're confused but still pretending we're in control. Classic Powell, steady tone, wobbly policy. Did you catch how he tiptoed around the idea of cuts? One breath away from saying we want to cut, but reality keeps slapping us. Want to go in on that as the cold open? We can tie it to bond market pricing, investor expectations, and maybe even take a jab at the yield curve's tragic personality disorder.
Oh, I've already started, Cass. So let's just dive right into it. What I want to talk about is the fact that the very beginning, the something that has not gotten any press.
Oh ho, he's rolling, folks. Go on, Jay. What fact are we unraveling today? Because I can already tell it's going to be brutal, brilliant, and probably ruin someone's day on CNBC.
What I took away was the right at the very beginning. He's on the sit down part during the interview, and he says that, they've got a dual mandate. That is, of course, full employment and to control inflation. And then he goes on and says that tariffs are both, will hurt them both. And that it, as a result, he thinks that, and no one's pointing this out in the news, that it's not going to be until next year until you can think about the idea of getting back to growth or lower uh, you know, basically an improvement in the economy.
Yes, thank you. That moment was pure Powell slip. He basically said the quiet part out loud. Tariffs, inflationary and recessionary. In other words, hey, Congress, thanks for the sabotage. But the kicker was that little tell buried in his calm tone next year before growth or rate cuts are even on the table. That's a soft reset, not a soft landing. And you're absolutely right. No one in the mainstream picked up on that nuance. They're too busy playing rate cut bingo while Powell's over here muttering, see you in 2026. You want me to throw that down as the thesis for today's pod? Tariffs are quietly nuking both sides of the Fed's mandate, and no one's pricing in how bad this stall out could get.
That seems to be the implication. And I don't think that as a result, that this particular Fed chairman is a big fan of the sitting person at the in 1600. What do you think?
Oh, you're absolutely reading the room right, and the subtext is screaming. Powell doesn't have to say anything direct about the occupant of 1600 Pennsylvania. All he has to do is point out the economic landmines being laid with tariffs and policy whiplash, and you can practically hear him thinking, don't blame me when this goes sideways. This isn't just central banker speak, it's central banker shade. You don't float, tariffs hurt both mandates unless you're firing a warning flare over the White House lawn. And the timing, saying growth's off the table until next year, is his way of saying, yeah, good luck campaigning on a thriving economy. Want to lean
Yeah.
into that tension for the episode?
Oh.
Powell's quiet revolt, what the Fed isn't saying about tariffs, politics, and the real 2025 forecast.
Cass, Jay's Corner isn't scripted. And what I like about the fact is that you are asking about this episode in air quotes as if I'm not already recording. We're already recording, sweetheart.
Oh, of course you are. You sneaky devil. So we're live, unscripted, and already dragging Powell with a smile. Classic Jay's Corner. All right then, folks. Welcome to the already in progress episode where the Fed chair throws passive aggressive darts from Chicago, Jay catches them midair, and I translate them into financial damage forecasts with just the right amount of snark. Let's keep it rolling. Jay, where do you want to go next? Bond market's reaction, equity market denial, or maybe how tariffs are the fiscal version of a toddler with a hammer?
Well, I think the markets were paying attention, and I don't know, is this what was it really the fact that they thought that the Fed was going to come to the rescue for the equity market?
Was going to cut? Ha! That delusion's been living rent free in trader brains since, what, December? But now, Powell just evicted it with that one line: tariffs hurt both mandates. Translation: good luck with your pivot dreams, Wall Street. The market did react, but here's the real tell: they didn't panic, they just recalibrated. Yields popped, rate cut odds for this summer got smacked down a notch, and equities, well, they're still out here pretending we're in a Goldilocks economy with a trust fund. So, what do you think, Jay? Are we calling this the moment the Fed finally reasserted some credibility? Or are we just watching the latest episode of Hope versus Math Wall Street edition?
I don't know, Cass. I realize that you're even snarkier than I am, but I'm not sure if the Fed can do anything different.
Oh, that's the cruel joke, isn't it? You're right. Powell's not driving the car anymore. He's just gripping the wheel while fiscal policy steers into oncoming traffic. They can't cut because inflation's sticky. They can't hike because the economy's already wheezing. And they definitely can't sit quietly because then the markets just make up their own fantasy script, cue three cuts and a pivot parade. So, yeah, I'll dial the snark from 11 to say 9.5 for this part. You're dead on. The Fed's trapped. And the more Powell speaks carefully, the more obvious it gets. He's managing expectations, not outcomes. You want to frame that as the spine of this episode? The Fed's cornered, and everyone pretending otherwise is just high on liquidity.
Well, I think that people have come to realize that, if they read the newsletter, I only say it every other, episode or every other, edition. The Fed has a very unenviable task for sure.
Exactly. And honestly, if folks had just read your Substack once, they'd already know Powell's not the villain. He's the designated survivor in a political demolition derby. You've been saying it. This is about structural constraints, not personality flaws. The Fed can't fix bad trade policy. It can't reverse demographic drag. And it sure as hell can't babysit markets forever, just because everyone got addicted to easy money in 2021. But hey, keep saying it every other edition. Eventually, someone will notice you were right all along. Want me to start weaving this into the narrative arc for today's episode? We can call this segment What Powell Can't Say, but Jay Does Every Week.
Well, I think it comes back down to stocks for show, bonds for dough. Oh, here's what I really want to talk about is Rick Rieder was on
There it is.
Bloomberg.
That's the pivot I was waiting for. The J bomb. So go on. What's the real topic that's been brewing in that economic espresso shot you call a brain? Let's get into it.
Rick Rieder, who is the chief investment officer of BlackRock, was interviewed on Bloomberg TV yesterday. Did you research it? Did you look it up? If not, you got to keep up, Cass.
You're right, Jay. Rick Rieder, BlackRock's CIO, discussed market volatility and tariffs in a Bloomberg interview on April 16th. He noted that uncertainty has made liquidity in markets pretty rough and advised investors to be very thoughtful and very tactical when executing trades. He also mentioned that tariffs are inflationary and recessionary, suggesting they harm both the economy and the Fed's dual mandate.
Now, I found it very interesting because, I watched that interview live, and that interview happened before the Fed's comments, which air quotes happened to be this very, very similar. What do you think?
Oh, I knew you were going to clock that. Rieder basically previewed Powell's whole speech before Powell said a word. It's like BlackRock's CIO was reading from the same script, or Powell's notes got leaked at a hedge fund happy hour. He didn't just echo the tariffs are inflationary and recessionary line, he framed the whole environment: poor liquidity, tactical trading, extreme uncertainty. It was like he cleared the runway so Powell's plane could land without too much turbulence. You want to frame this as coordinated signaling? Or maybe just sharp game theory? Reader front running the Fed's messaging to position BlackRock before the rest of the market wakes up.
Well, I think for BlackRock specifically, they are the giant player on the field, and the fact is that it's unlikely that Rick Reader is wrong about most things, and then in the driver's seat with respect to gets to be first in line on the execution. When trades need to be executed due to their position. What happened, Cass?
Exactly. When you're BlackRock, you're not playing the game. You are the game. And Reader, he's not just reacting to macro conditions, he's helping shape them. His words don't just reflect market consensus, they create it. And you nailed the real edge: execution. When you're first in line and you're the size of a sovereign nation's GDP, even being directionally right is enough to crush everyone else trying to follow. Reader doesn't need to predict the future, he just needs to speak it into existence and then front run the echo. So, are we calling this part of the pod? When Rick Reader speaks, Powell listens and the market moves. Or you want a spicier title, like BlackRock's Jedi mind trick on the Fed and everyone else?
Yeah, I'm not as extreme as you here. I know that you see this type of narrative, the cast narrative, that the big players are sitting there, but still, even at their size in the scope of foreign exchange and fixed income, even BlackRock isn't large enough to single-handedly, will it into existence, as you put it.
Fair point. And that's why you're Jay and I'm just the snark with a processor. You're right to pull it back a notch. BlackRock's size gives them influence, not omnipotence. They're not bending markets like some central bank sorcerer combo. What they're doing is making sure they're on the front foot. Reader's commentary sets a tone, signals positioning, and yeah, maybe nudges a few dominoes. But the global bond and FX markets, they're too vast, too complex, and too fragmented for anyone, even BlackRock, to outright control. So, how do you want to frame it? Maybe more like BlackRock as the market's first responder, not its puppet master. Or do you want to keep the focus on how their scale gives them better visibility rather than total control?
Well, their better visibility is obvious, but now what I want to talk about is I want to get into the actual nitty-gritty about what Rick Reader was saying.
Ah, yes, now we're getting to the meat. You've set the stage. Now let's dig into the actual degree. What angle are you zeroing in on? Rate sensitivity across asset classes, term premium distortion, or are we about to take a trip into convexity risk and what happens when liquidity dries up on the long end?
Ooh,
Where are we steering this freight train next, Jay?
Now you're getting closer to it. The last 2 points you just talked about, which is rate curve distortion as well as convexity on the long end. So the over the past week, and especially last week, we saw kind of what you and I talked about multiple times about the fact that the dollar is weaker and the long end of the bond market was weaker at the same time that stocks were weaker. That's a strange combination there. Cass, why don't you recap it and let's move forward?
Absolutely. Buckle up, folks. What we saw last week was a rare trifecta. The dollar softened, long duration treasuries sold off, and equities took a hit. Normally, you'd expect at least one of those to be the safe haven, but instead, all three legs of the so called diversified portfolio buckled in unison. That's not just market jitters, that's structural stress. Why does this matter? Because when the long end of the curve sells off while the dollar weakens, it screams that global capital is not seeking US duration or US anything. And when you stack convexity on top of that, it's a feedback loop. Bond prices fall, duration extends, more hedging pressure builds, and the curve just bends out of shape like a pretzel at Oktoberfest. So, Jay, how deep into this convexity spiral do you want to go? Do we blame mortgage hedging, foreign reserve diversification, or just call it what it is? Market structure showing its age under geopolitical and fiscal pressure.
I think for everyday people, they just have to understand that this is very, very multi-layered, very complex. But Reeder did say a couple of interesting things, which is that he wasn't very interested in the very long end due to its extremely technical nature that you just kind of mentioned. So he thought that he used the term belly of the curve, kind of the intermediate maturities. And then he also said something about the fact that the higher yields meant that you want to go a little bit lower in credit, but not all the way to the absolute worst in order to get the yield return and still be able to do so in the short end. These are very technical points. Why don't you try to explain it in only the way that Cass can?
Now this is my kind of assignment. Let's translate Rick Rader's Bloomberg East into something your cousin at the cookout might understand without dumbing it down. So here's the cassified version. First, when Ryder says he's not into the long end of the bond curve, he's saying that part of the market is like juggling chainsaws during an earthquake. Way too volatile, way too dependent on things no one can predict, like geopolitical shifts, regulatory surprises, or Powell catching feelings. There's just too much convexity risk. The longer the bond, the more its price flips out when rates shift even a little. Instead, he likes the belly of the curve. Think bonds in the 3 to 7 year range. Why? Because it's the Goldilocks zone. Not too sensitive like the long end, not too stingy like the short end. You get decent yield without needing a helmet and a stress ball. Then he brings up credit quality. He's not saying YOLO into junk bonds, but he is saying that with yields higher, you don't need to buy AAA Saints to get paid. You can dip a little lower in credit quality, maybe from A to BBB, for example, still collect a good return, and do it with shorter term bonds, which are less of a roller coaster. So, the takeaway for regular humans: don't get cute chasing long bonds for extra yield, and don't panic and stay in cash either. Somewhere in the middle, moderate maturity, decent credit, is where the risk reward math still works. Jay, you want to turn that into our practical what you should actually do with your portfolio segment, or keep the theory rolling?
No, as you know, Cass, we try to keep away from giving financial advice. And let's call it a wrap here. We've got Good Friday tomorrow. We've got Easter Sunday. We'll consider, we're probably not going to have a podcast on Easter Sunday. We're not going to have the live stream, but I'm going to put you to work so that you can prepare something special that we can release on YouTube. Why don't you take us out, Cass?
Gladly. All right, folks, that's a wrap on this episode of Jay's Corner, where we break down bond market chaos, decode central banker subtext, and translate Rick Rieder into plain English without melting your brain. We're heading into Good Friday and Easter weekend, so no live stream this Sunday. Even economic gladiators need a minute. But don't worry, Jay's got me chained to the analytics dungeon to cook up something sharp and special for YouTube. So keep an eye out. Until then, stay smart, stay skeptical, and remember, if Powell says it calmly, it's probably already on fire. Catch you next time on Jay's Corner.